Larry's the managing director at Exchange Capital Resources. Larry, good morning to you. Thanks for giving us part of your busy Friday morning to take a look at the number with us in Market Reaction 2. Let's dive right in. Non-farm payrolls, a bit of a miss here. I noticed 245,000. They were looking for 469, and then with last month's getting revised down a bit too, this kind of feeds into the narrative in terms of what we've been talking about as far as lockdown measures and businesses struggling really to reopen and hire back workers.
Yeah, that's right. And when you look at the headline number, it does appear to be an enormous miss. So why isn't the market reacting differently than it is right now, at least in the morning? And I would suggest that it's backwards looking, and it's not including the vaccine. It's not including the optimism that the market has with regards to the vaccine, inoculation rates, etc. But that said, I mean, it is a fairly large miss, and I think the narrative might shift now, where the market will now focus a lot more on the trajectory of the vaccine. Not that it had been dismissing it. I think it'll just be center stage, because honestly, today's report, I was really looking forward to it, but I know it's backwards looking, not forwards looking, and not really surprised that the market's kind of muted right now.
All right, one question I have about these jobs that everybody's talking about, and we'll get into the wages here in just a minute because that's an inflation component that the Fed's dialed in on as well. But in terms of some of these jobs, I mean, I guess I wonder, is the concern here that the longer it takes for us to get back on track, for the economy to kind of get back to full steam here, I mean, ultimately, the longer it takes, these jobs, the brick and mortars especially, they become more susceptible to not becoming jobs that are unemployed or out of work, but basically just jobs that are completely wiped off the map here.
Yeah, no, it's a real concern. It's just that our bar is so much different than we think it is, because just keep in mind what we baked in, what we thought might happen in the early summer, late spring, early summer, and so that we need to get to that point, or the market needs to think we're going to get to that point, with all the fear with regards to job loss, et cetera, for the market to really turn around. It's right now, it's more about the optimism over the vaccine and less about service sector and jobs in general. I mean, yeah, the jobs rate needs to come back to participation rates leading the unemployment rate. That doesn't make me really encouraged, but jobs have come back, and GDP is only 3.5% off of where it was in March of 2019. So we've come a long way, and I think the market realizes that.
Talk to me about the wages component here. We know that the Fed's not only concerned about maximum employment, but also, again, they're looking at the potential for inflation here. And it really, at this point, it's just potential for. But average hourly earnings inching up a little bit higher than expected, 0.3%. Now, if you take a look at the average hourly earnings, though, year over year, I mean, this is starting to potentially raise some eyebrows at this point. 4.4%. That was above expectations. And it does look like last month's 4.5 actually got revised down to 4.4, so that might mute some of the concerns, I guess. But as you can see here, again, I mean, these numbers are inching higher as well.
Yeah, and so it's been encouraging. I think those numbers actually are supporting the market right now, because let's face it,
that's not a bad thing.
It's actually what the Fed is hoping or wanting to happen. And when you look at the break-even spreads, they hit almost a 2-year high this week. We have a 210 continuing to steepen. So there definitely are inflation expectations built in, and you're also seeing the dollar fall off. I mean, people keep saying that dollars had a huge sell-off, and it's at 2018 levels, but overall it's still pretty strong against most majors in a 5-10 year term. But all that to say, wages, inflation expectations, that's what's driving a lot of this market as well. Something that, as we all know, has been just completely benign for the last 5 to 10 years.
Larry, we've been talking about the dollar. I'm glad you brought it up here. We actually just pulled up the chart. We, again, are holding near the overnight lows. We're at 90.59 last, down by about 0.2% here. But notice how, as you mentioned, Larry, back to multi-month, multi-year lows, trading April levels from 2018 and holding up above that 88.15 from the beginning of the year. But let's talk a little bit about what ultimately this weaker dollar means for the indices, because you could argue it's coronavirus vaccine news. news. You could argue it's earnings, economic data. I mean, we've talked about some of the other drivers for the indices to the upside, but I keep reverting back to the fact that the dollar continues to weaken. This is very supportive of U.S. indices here, especially some of the multinational companies. Larry, talk to us about how this could be, or is it one of the driving forces?
Yeah, no, I think it definitely is. And, the headlines you read is that, dollar is getting slammed, it's getting trashed, and that's not so. We're back to 2018 levels. It makes sense with regards to cross rates between the U.S. and especially Europe. But right now we have fiscal stimulus pending. We have inflation expectations that are much higher than they've been in a long while, especially compared to other nations. And, all that to say, it's going to put pressure on dollar and put it back perhaps into line. And I think that's actually adding a tailwind to the risk on environment that we're seeing right now. It just doesn't need to go down too much. But I do think rationing down a little bit is healthy for the market. But I do need to say that overall, I still remain a long-term bull, the U.S. dollar. Haven't been very right lately, but I still think the structural changes in our society, in our economy, that the U.S. Dollar will rally over the long haul.
All right, let's talk a little bit about what could be behind some of that rally, because we've been watching foreign currencies, which for the most part have been weighing on the dollar right now. The bid we've been seeing in the Canadian dollar, the euro currency, you could bring all the way down the line. I mean, not so much the yen, but Asian Pacific currencies like the Australian dollar, the New Zealand dollar. I mean, these have all been pretty well bid. This heads into, or this is ahead of, I should say, some central bank activity. The focus next week is going to be on, I think it's Bank of Canada, the ECB, but then the week after we're talking shortly thereafter, we'll be in having FOMC discussions again, Larry.
Yeah, and that's right. And everything that's built into consensus, and let's keep in mind, consensus doesn't have to be right. It doesn't have to be wrong. It's just consensus right now. But it just seems like everything points to a lower dollar, especially when you think of Canada and Australian dollar. I mean, you have commodity currencies, and commodities have done very well. And that's, dollars down, so that should be expected. But that said, everything is built into the fact that we're going to have inflation. We're going to have either an extension of weighted average maturities from the Fed and or some fiscal stimulus bill passed before Christmas. So everything that's on the table looks to be dollar negative. And so right now, I think that's built into the market. And one of those things become unwound, we'll see a pretty sharp rally in a dollar in short order.
Larry, last question. I'm kind of concerned that the market has this sort of, investors, traders have this kind of Pollyanna type approach towards viewing these vaccines. And I mean, we even heard from Pfizer recently about how they're cutting back some of the expectations for deliveries, about half scaling back because of materials required too. I mean, this is an unprecedented endeavor right now that they're embarking on, some of these companies. And then the other thing I was thinking about, with the similarities in some of these drugs, whether you're talking about Pfizer or some of the other companies that are producing these drugs, I mean, ultimately they're all going to be looking for the same resources to produce these and these materials. I mean, is there potential for some speed bumps along the way? And have we been focused too much on the positive and not considered some of the potential negatives here?
Yeah, I would say perhaps. But I think the market, we both know the market's not dumb, and
it can correct quickly.
We might be, but the fact is, I think the market's properly balancing the speed bumps that will be along the way, and not looking back. I mean, realizing how bad things were perceived to be when you look at March, April, and May, and now we're like, okay, it's not that bad. It's not at that level. And will there be speed bumps? Yes, but there's also going to be a rollout, and it's more about the inoculation rate. When are we going to get to 10%, 20%? What is that going to do? And I think the market's baking all that in, as unbelievable as it seems.